Hi everyone, welcome to RHB Bank's Money Chat series. I'm Nova Lui, Head of Investors Advisory. I'm honored today to have Frank Benzimra, Head of Asia Equity Strategy and Multi-Asset Strategies from Societe Generale, joining us today to share his thoughts on global equity market. Frank joined SocGen in 1994 and has worked in various equity derivative and research positions in Paris, Tokyo, and Hong Kong. He is currently head of Asia Equity Strategy and a multi-asset strategist. Frank is part of the Global Asset Allocation team, which was ranked number 1 in the Excel survey from 2008 to 2019. SocGen is active in real economy for more than 150 years and is one of the leading European financial services groups and offers a wide range of advisory services and tailored financial solutions. Frank, thank you very much for joining us today.
Thank you very much.
Frank, global equity market, including Nasdaq, which has dropped near to 30% year to date, mainly contributed by the aggressive rate hike by US Fed. There is a lot of interest on high beta market to tap on the existingly attractive entry point. However, it is also said that technology or growth company in particular are more correlated to rate hike cycle due to higher borrowing costs. Do you see Nasdaq has a potential to record positive return over the 1 to 3 investment horizon?
Yes, I think so. And I think that an important question for investors is which asset will perform once the Fed stops hiking rates. So historically, it has been the US Treasury and the long maturity, the 10 years Treasury. Over the last 40 years, US Treasury yield constantly decline in the subsequent 2 years after the last Fed hike. So what is interesting for an index like the Nasdaq is it has what we can call the long duration. So that means that the valuation and the return of the index are more dependent of the level of interest rates than indices such as the S&P or the Dow Jones, which are including a higher proportion of so-called value stock. So and those value stocks are more companies where the share price are more a function of the near-term earnings. And there is another observation that I want to make on the Nasdaq. It's the remarkable historical return. Let me just give you an example. We look at the history of the last 50 years and assume that every day you invest in the Nasdaq index and you hold the position for 3 years. Statistically, you would have an 83% probability of getting a positive return and a 41% probability to have some annual return comprised between 10 to 20%. So now we know that the past is not necessarily indicative of the future, but it helps to understand the different investment context. One period when the index had a negative returns was in the early 2000, and that was due to the extremely high valuation of the Nasdaq. At SocGen, we are capturing this extreme overvaluation with what we called our risk premium, our equity risk premium model. And we can see that the premium, which measures the difference in expected return between equity and bond, was very, very compressed in the early 2000s at the time that the market fall. And today we are in a different context. The premium is around the average. So it means that in a medium-term investment horizon, once the Fed stops hiking rate, the Nasdaq would be well positioned to benefit from what we think would be a more benign rate environment.
Okay, thank you, Frank. It seems like it actually offers a good investment opportunity for investor that has a relatively longer time horizon, say up to 3 years down the road. Since aggressive rate hike remains one of the biggest fear, the latest Fed dot plot suggests terminal rate to reach 4.75% by Q1 2023. But it seems like market are even beginning to factor in a 5% terminal rate with 75 basis point hike in November and December FOMC. What is SocGen's view on Fed's terminal rate by Q1 2023?
Well, the central scenario of our U.S. economist is we expect the Fed fund terminal rate at 4.5, 4.775 in the first quarter of 2023. And so this central scenario is built on the premise on the core inflation peaking as growth is slowing down and rent inflation is finally coming down. So having said that, one important takeaway from this year rates environment is how the market has been data dependent. And of all asset class, interest rate, the rate is by far the asset class where the volatility has been the highest compared to its usual regime. And just let me give you an illustration. When you look at how the market has priced the terminal rate of the Fed fund, it has been repriced constantly up and up, especially since the last summer when we had this message of the Fed becoming more and more aggressive. And the reason why the Fed have become so aggressive is that we saw the worries on the high headline inflation that we had a few months ago because of the price of oil, the price of commodities. Progressively, these concerns are moving to the core inflation, and this is because of the wage growth acceleration. And there are some extreme case. So we have some model. One model is called the Taylor rule. It is estimating that the Fed fund could go under certain circumstances to 7%. That is not the scenario of SocGen, but that is a risk scenario in case the core inflation is remaining stubbornly high.
Dear investors, it's a very rare opportunity that we have Frank with us today. If you have any questions about the global equity market or US equity market, including interest rate hike, please put down in the comment box below. We will try to answer your questions as soon as possible. US have recently sanctioned the sales of high-end microchips to China and incentivized companies who are affected by the embargo. At the same time, the US administration aims to build resilient supply chain, notably in the semiconductor industry with the US CHIPS and Science Act incentive. How would you get exposure to the new industry policy in the US?
Yeah, so there is certainly a paradigm shift, and we think that investors should prepare for a changing world order. And well, we see some evidence, most obviously in the semiconductor world, where firstly you have this unprecedented export restriction against Chinese firms by the US administration. And secondly, you have a more proactive industrial policy, notably with the US CHIPS Act. And the CHIPS Act, and along with the so-called Inflation Reduction Act, is aiming to bring back some business, to bring back the supply chain in critical industry in the US. And here you have some challenge. One is obviously about incentive. Is it sufficient to have all industrial facilities back home, but also about resource, whether the US has enough resource, including human resource. And we find in our research that some industrial firms in automation, for instance, they are clearly well positioned in the reshoring move, which actually has been underway in the US since the tariff war of 2017. And this group of companies, they have performed well over the last 5 years relative to the market, relative to the industrial sector, and they are expected to do well actually as more reshoring is happening. So what I mean here is that it's not going to be necessarily the semiconductor sector which are going to be well placed by the CHIPS Act, but more some segment of other technology of some advanced manufacturing sector which are making possible the reshoring. And maybe one final thing that I want to add is from an economic point of view, the good news from the US perspective is you will see a lot of new manufacturing jobs being created. The US administration is putting the number at 350,000 jobs being created in the next couple of years.
Okay, recession. The R word that has been recently spoken a lot. In late October 2022, US large tech company earnings fell below analyst expectation, with Alphabet announced a 50% hiring cut. Microsoft cut 1,000 employees in selected division, and Meta shareholders are asking Facebook to cut jobs. This headline has sparked a lot of fear for recession for our investors. What is your opinion about the outlook of a recession in view of technology sector job cuts?
Well, first of all, one observation. We had the latest GDP number very recently, and they were good. So we had a strong business investment number, a strong contribution to net export, and overall the employment condition as a whole. They remain relatively robust despite the job cuts, the hiring freeze that we can see in the tech sector and in some sector which were very actively hiring during the COVID period. So now for equity market, I think the worry is what we would call an earnings recession. When you look at the earnings, the US profits, they have been very remarkably resilient since the pandemic recovery of last year. Even with inflation rising, even with a strong dollar, earnings being revised downward in every part of the world, we have generally seen some good earnings season in the last 3 quarters in the US. And the market consensus is expecting profit to grow in the low single digit next year in 2023. And in our own analysis, we find this a little bit too optimistic. And our central scenario is actually to earn the earnings to decline by 5% next year in a context where you don't have a recession, but you have a soft landing. So now, if you're having a mild recession, then you could see the earnings falling by a more significant amount, and we could see a contraction by around 20%, which is typical of the past downturn when you have a mild recession. So now, back to the recession outlook question. To see a recession in the US, I think we will need to see also some downturn in the housing market, and meaning that the household consumption would fall, because so far what we've seen is the consumer confidence in the US is very low, and this is because of the rising inflation, but the real economy so far has remained resilient.
I always get this question about when is the market going to bottom. Frank, in your opinion, is there a key turnaround point that investors should watch out for the sustainable recovery of the US equity market, especially the Nasdaq underlying stocks?
Yeah, I think you're right. And to call the bottom is always a very, very difficult task to do. But I think there are a number of indicators that we can look at. And first of all, I think it's important to understand what caused the current equity bear market in the US. And it has been, I think, a combination of two elements. The rising interest rate caused by the inflation concern, so that's most important element, but that was the story at the beginning of the year. And more recently, we had some profit disappointment, especially in some cyclical sector. Think of the advertising, for instance, or even the semiconductor. And that means that investors should watch out at three indicators for the US equity to recover. The first, the most important, is what we call the Fed pivot. So that means the meeting when the Federal Reserve will not hike interest rate. And for the Federal Reserve not to hike, we need to see the inflation soften, and the nature of inflation now, and the key concern is the core inflation, which is driven by rent, which is driven by what we call the shelter CPI. And for this to soften, we should see wage growth to slow. And that means that very roughly on our US economist estimate, maybe 4 or 5 non-farm payroll report with less than 150,000 jobs being created, that will make us think that the Fed could stop hiking. So this is one very important element to watch, and so that means we are also going to watch at the wage growth, which has been accelerating at the highest rate over the last 40 years. So we need to see the wage growth started to slow down. So these are, I would say, some indicators for the real economy. And we are also looking at indicator in the financial market. One is what analysts are calling the earnings momentum. So how deep are earnings downgrade? So we need to see more downgrade in the earnings before getting some views that the bottom has been touched. And we also need to look at the credit market, very important asset class for the equity investor, and to wonder whether we have seen the peak in the credit spread widening. So maybe we are not completely there. So these are some of the important indicator in the financial market that we are also going to watch out.
Thank you very much for your sharing today, Frank. A lot of investors is looking to deploy their money into the investment today. But is there any final advice from yourself for investor that has cash ready to be reinvested into the equity market now?
Well, I think one very important thing to do when we invest, especially on the equity market, is well, we need to look at the history. We need to look at what kind of return you get over time and what kind of volatility. So that means that we know that there will be period where the market is going to be difficult and period when the market is going to be very strong. But on average, and especially on the US equity market, you can expect some decent return. And to get those returns, the most important thing is to be patient. And so maybe my final advice is really let's be patient when investing.
Okay, thank you very much for sharing today, Frank.
Thank you very much for inviting me.
Dear investors, it is important to have a well-diversified investment portfolio, which includes exposure in both developed and emerging markets. As the pace of rate hike cycle differs within the global central bank and market reopening post-COVID-19 are executed differently, it's important to get the latest update from our relationship manager to make an informed investment decision. Please contact your RHB Bank's relationship manager to get the latest market update and investment ideas. Thank you again, Frank, for joining us today.